So this hour, we are going to talk about the sweeping overview of collections financial analysis. So in an hour, I'm going to give you the basic bones nutshell of what financial analysis is and how we kind of do the basics of it. So again, this is the slide about me. Mentioned to you about this earlier. Again, this is my most recent book here, available on Amazon. Now, again, sweeping overview. Here we're talking about the purpose of the collection financial standards. We're going to understand some basic concepts. We're going to talk about the most common appeals process for collections actions. We're going to talk about the 433F a little bit in here, since really the F, we don't talk about it anywhere else in terms of the classes. Now, remember how we have the CTR. We'll talk about this. In fact, this particular class, we split out into two different 2-hour sessions. One, the basics, understanding how we go in to do the calculation. And then the second class is actually the giving some examples and walking through some numbers. So, audience participation. Let me open up the chat here. What is the purpose of the collection financial standards? And so this is where you guys get to say, why does the IRS want you to submit a 433? What is it? What kind of information are they getting is basically what we're looking for at this portion of the class. Anybody will do. Nicole, what the taxpayer can afford to pay. Anybody else? Well, to see what your spending is and what your RCP is. Okay, anybody else? Going once, going twice? Okay, so ultimately what we're trying to do is find the taxpayer's ability to pay, or in this case, repay their tax liability. Now, when we talk about the taxpayer's ability to pay, what we're really looking at and what we tell people is to look at an analogy of how somebody applies for a mortgage, but we're doing this in reverse. So let's just look at the normal mortgage process. Say, I want to go buy this house. You go to the mortgage company and you say, hey, I want to buy this house. Here's what I think I can afford to buy. You give them all this paperwork, and then they basically go through it and they say, okay, based on this, you can afford to qualify for this. This is what the payment's going to be. The numbers are going to work. You can afford to buy that house. They give you the money. You go buy that house. Well, here you've done it in reverse. They've actually gotten the loan. Now we're submitting the paperwork to actually determine their ability to pay that liability. And that's an analogy that we recommend that you use when you're explaining it to taxpayers, because unfortunately, there are many people out there that are not very sophisticated, and it's easier for them to understand, even if they've never been through the process. Most people know what it needs, usually what it means to go through and get some kind of loan. Here's what we're trying to determine. This is the scope of these collection financial standards. One, it differentiates between necessary and unnecessary living expenses. And keep in mind, there's going to be your definition, your client's definition, and then there's what the IRS defines as necessary and unnecessary. Keep in mind, this is based on household income. We don't go into it in depth in here. In fact, I don't even really go that too in depth in CTR 111 or 112. But this can come into play for those situations where adult kids live in the house. There are roommates who live in the house, boyfriend, girlfriend live together. By those people, even if it's not their liability, that those people being in the house can affect their ability to pay the expenses, because obviously if these other people have income and if they're paying their share of those expenses, that can increase the person's tax, the person who has the tax liability, it can increase their ability to pay. The numbers are designed around a middle-class lifestyle. Please also note that these numbers are presented on a monthly basis. Even though you just have to work the numbers and to determine, they give it to you quarterly, work on it monthly. If they give it to you biweekly, then there's a factor to calculate that, and so on and so forth. Now, these numbers are reviewed quarterly and updated Historically, since I've been doing it, they've been March, but this year they released them in April of this year, at the end of April. They typically do it at the end of the month before the deadline, the final 1040 deadline. Now, allowable living expenses. Okay, there are three types of allowable living expenses. Just allowable living expenses, which is obviously based on the national standards, which we'll talk about here in a few minutes. Then there's other necessary expenses, which we'll talk about here in a second. And then there's other conditional expenses, and this is where you get to earn your pay. Conditional expenses such as maybe tithing, maybe paying for a kid's college tuition, or paying for them to go to a private school. Normally, those types of things don't qualify. However, there are certain situations where you probably can make an argument, and we have, and some people have been able to prove that. Now, the necessary expense test is defined as expenses that are necessary to provide the taxpayer and his or her family's health and welfare, or production of income. So it could be both, but it's usually one or the other, meaning that they need this for the health and welfare. So, like, for example, if I was talking to pay the private tuition for a kid, maybe the child has some special needs that the only place that they can go, the public school system can't afford to, or doesn't have a program for that child in their condition. That is a necessary situation. Production of income, tithing. If you have a pastor who is giving. Now, for me, I had a tax problem. Tithing wouldn't be a thing that they'd allow me to do. But if I was a pastor and that's a requirement of my income that I have to give, or my contract, then they have to allow those types of things. Now, when we look at the allowable living expenses, the abbreviation here is ALE. Please know that they're pay attention to the context of what's being done, and because ALE is also another term in regards to the applicable large employer in health insurance. But ALE in this example is where the collection financial standards are. And again, we talk about it further in depth in CTR 111 and 112. And we will go through and determine this is what the IRS allows as necessary living expenses, the minimum or maximum that they allow for certain categories. Now, when are you going to use these standards? The standards are used first. If you go through and do an offer and compromise, probably need to update this slide a little bit, as this number, I believe, has come down, but 0.28%, and that's 0.28. So let's call it 0.25% of cases are resolved through an offer and compromise. So if you're looking at it from this many cases are resolved through an offer and compromise. But the allowable standards help you determine, as Cruel put up in the RCP, our RCP is reasonable collection potential for your offer and compromise. It can also help determine whether your client is available or eligible for currently non-collectible status, which is roughly 15% of cases, and any installment agreement that is not guaranteed or streamlined. Now, why do we say not guaranteed or streamlined? Because guaranteed or streamlined, they're easy slam dunks, and typically we're going to use these standards when you're submitting a 433A. So, a large one where it's over $250,000, somebody who's getting into a partial pay, those are the ones that we're going to be looking at here. Now, you need to know these. You need to get the information from your client. But what we always say is trust but verify. It's one of those, you trust your client, even if think you know the client, you don't know the client. When I go through the CTR 111 and 112, I prove to many people that you're probably, unless it's like your brother or sister, or some really close friend, you probably really don't know your client, even if they are a good friend. But trust them as far as you can throw them. Make sure that you get some information to support the numbers that you're given. Now, so another quick note about the standards, that your client is allowed the full amount without questioning certain expenses. And in some standards, the taxpayer is allowed the lesser of those. Again, we go through that in the example case in CTR 112. We go through an example using our buddy, what we call him, Randy the Realtor, and we say Randy's got this particular fact pattern, these circumstances, and here's what we do. We calculate it here. What's he eligible for? We calculate it here with a few facts different. Here we do a third one, and then finally the last one, and say what could be some things that we could recommend to our buddy Randy that we could help him reduce his tax liability based on what he's doing to this point, that it's the difference between him paying the IRS or him paying somebody else, some of those things. So again, this is where you get to make your money. And so we have to basically demonstrate why these things apply, and sometimes it's necessary to exceed the standards. And I'll talk a little bit about that here coming up. Now, first one is called the lump sum national standard. This category is called food, clothing, and miscellaneous. And when you look at it, these are the standards. So this is one of those where it's allowed without questioning actuals. Now, if you go to this particular page, and I always like to put this up, and so you can see what it actually looks like. So if you go to the IRS collection financial standards, and you actually see this page, this is the IRS's page, it tells you each of these categories that we're going to go through. So if you click this button, it actually tells you what the breakdown of each category is. This is what it is for one person, two person, and then each additional person is this. Now, ironically, these numbers increased here since the last time they redid this, but this number decreased because we know that, and I say this because I've been one. If you've ever had a teenage boy in your house, you know that even, so if you have 3 boys, that this is probably not enough for having that type of situation. But it says here, it says taxpayers are allowed this standard without questioning the amounts they actually spend. It's actually in writing on their site that you get to use the number from the chart. So what I say is you need to look at the details and see, have your client present this. This is where you use it. It's best to use a software tool. I use Canopy, but there are others out there, Tax Help Software, Pitbull. What is it? The one that you talk about, Jason? I can never remember it. If you can think about it. But any of these tools to help people fill out a survey so that they can provide the details of what they're spending for each of these different items to see if whether or not they exceed it. Now, a good example would be, and I use myself as an example, I say we're always fun to go out to eat with. So here's a good example. I am gluten intolerant. I am intolerant with cane sugar, and I'm a vegan. My wife is vegan. I have 2 daughters that are vegan, and one of them is lactose intolerant. So I say we're fun to go out to eat with when you have this type of situation. But gluten is an allergy. A vegan is a choice. So there is a difference. So if you have somebody who has a peanut allergy, some severe allergy like celiac to gluten, then this might be a category where you might need to exceed it. Because if you've ever had to buy that type of food, it's sometimes not cheap. For if you need to buy organic, you need to buy certain types of non-GMO type foods, then this might be a category where you do here's what it would be if they bought normal stuff, and here's what it is with what they buy, so that you can show what the difference is, that you can exceed those particular amounts. Okay. So this is where you get to take, even if it's less, you get to take the number that's actually on the chart. Now, when it comes to healthcare, you get actual out-of-pocket costs or a standard amount that is currently $68 for anybody, and it's $142 if they're over 65. But how do we calculate this? Now, if you're taking the standard amount, it's 68 times what? Here's where we say look at what the number of dependents they claim on their tax return, and you multiply that by 68, and if they're over 65, then it's 142. Now, if by chance the actual out-of-pocket cost is greater, then you're going to take the actual out-of-pocket cost. So somebody over 65 is more likely to have the opportunity or that they're spending out-of-pocket medical care costs that are going to exceed 142 on a monthly basis. Now, when it comes to health insurance, it's actual. Whatever they're paying, that's going to count. So when they have Medicare, when they have the supplemental Medicare premiums, all of those things, this is a category in which they get to take actual. Anytime you have an actual category, that's wonderful because that provides a little bit of flexibility depending on certain types of situations. Now, the third one is transportation standards. Now, in bigger cities with clients, they can have public transit. Sometimes people don't even own cars. But if they take public transit and they own a car, they can take one or the other, but not both. Now, when it comes to the actual car, there's two pieces to it. There's an ownership cost and there's an operating cost. Now, if they have the car that's free and clear, meaning they don't own a car payment, so they don't have a lease or a loan payment, then you only get one. You don't get the ownership cost. You actually have to have a payment in order to get the ownership cost. So this is another area that provides some flexibility that actually I'm working on with a 74-year-old woman. Now, she could use it because she's actually driving a like 1990s Corvette for a 73 or 74-year-old woman who lost her husband due to COVID, in fact, almost a year ago at this point. So this is one of those things where we're saying, hey, go buy a car. You know, I don't normally advocate for people to get into debt, but here the choice is pay the IRS or have something that you can use and we can easily justify, especially in her particular case. Now, when it comes to the public transit, they get $217 a month. That's it. It's a nationwide number. And that's it. You get to that. There is no other choices. Now, when it comes to ownership costs, again, these are nationwide numbers. So the guy who's driving, and I've had this before, he's driving an $800 BMW or Mercedes lease payment, then he only gets to take $533. Here's a guy that you would recommend, hey, maybe you need a downside there because that would free up some cash. And obviously, they have to decide for themselves, but that's obviously a recommendation you can make. And there is a 2-car limit. So you're going to have to make an argument for multiple cars. But if you're going to have multiple cars, then it's something like maybe there's an additional child that works that provides the household income. Now you have to include his income, and then you're going to end up maybe being able to get a third car. Now, in terms of operating costs, these are numbers based on a region or metro area. And here's where another area that I like to provide some detail. Now, coming back to the food, clothing, and miscellaneous, this is a nationwide number. So the number that I presented to you here for food, clothing, and miscellaneous applies to me in Florida, to somebody in Alaska, to somebody in Hawaii, California, New York, or in Iowa. So it's the same numbers. And unfortunately, that's the rules we have to live by. But I could make an argument that somebody in California or somebody in Hawaii or Alaska is probably paying a lot more in this particular category than I would or my client would in Florida. Now, when we come down here to the transportation standards, here's where I like to show you the details of what this looks like, because it tells you here's the public transportation number, here's the amounts for ownership costs, but here are the numbers for operating costs. Now, see, Carlton, you're in Texas. I think, tell me where you guys are, what states you guys are in, and we can kind of look at this. But so if I look at the South region, you're in Houston. So Houston has a number, but so does the number here for the South. Well, if you were in any other area in the South, so like for me, my city is not listed on here. So I take these numbers here for the South region, where I am in Florida. Carlton lives in Houston, so he gets the benefit of an increased amount here for him and his clients. Well, how do you know that you are in the Houston area versus the South region, or Dallas Fort Worth, or Atlanta? Well, if you slide down further on the page, you can see that if I slide down here to the South region and I look at Houston, it actually tells you what counties are considered Houston, the city of Houston. And what you may find is that there are some spots where, wow, that seems kind of far to include that. I'm originally from the Tampa area, so to include Hernando County, that seems like a bit of a stretch to me. When you look at Atlanta, I think I counted these are like 20 counties that are considered the city of Metro Atlanta. Then it also tells you what states are considered the South region. So I show this just to, again, give you the details that are there. Thank you, Cruel. In Arkansas, you're considered in the South region. Obviously, you can see there's no states in there that or no cities in Arkansas, so you're just considered the South region for you and your clients obviously in Arkansas. If you're near like Tennessee, then you need to look at like Memphis or something. You have to look at that. So now, please note that if you're dealing with an offer and compromise on the vehicle, and it's only for an offer and compromise if the vehicle is 8 years old or more, or 100,000 miles or more, you get to add an additional $200 to the operating expense. So in the example here for the South region, it's $224 for one vehicle. That one vehicle meets one of these two criteria, then now it's $424 you get to put on in the area for the operating costs for that vehicle. Now we come to the housing and utilities category. Now, housing and utilities is broken into these different pieces: rent or the mortgage, and the mortgage is the principal, interest, taxes, and insurance, the PITI portion. Includes repairs and maintenance, gas, electric, water, garbage, home phone, cell phone, cable TV, and internet. So this is where we say that, yes, the IRS deems a home phone, cell phone, cable TV, and internet as necessary expenses. However, you can understand that this is one of the categories that's the most exceeded categories. And I always like to ask, how many of you actually still have a home phone? I gave up my home phone at this point, probably about 13 years ago, 12, 13 years ago. I've been strictly on a cell phone and haven't had a landline. I still don't have a landline. Even in my office, I have voice over IP phones. So I don't even though they're kind of landline type phones, but they're voice over IP, so they run through the internet. Now, here's the numbers of what this looks like. Again, I like to bring this down to show you exactly how it goes with the IRS. So let me back out of the transportation section and we'll slide up to the housing section when they get there. So we click over here to get to the housing section. Now you can see the difference here. The transportation standards were broken down by region and by metro areas. The food, clothing, and miscellaneous and the health stuff is nationwide, but the housing and utilities is broken down by county. Now, I like to go here through Florida because I know the Florida county is a lot better than I do anywhere else. I am here in Brevard County. So if I have most of my clients, this is their thresholds and what they qualify for. Broward County is down near where Miami is. Okay, Alachua County is where Gainesville and University of Florida is. And now I'm a rural or a coastal county. So to have 1407 for one person, that you can see how this is that's not a very big number. If I slide down here and I get to a more populated area, Hillsborough County is where Tampa is. So here's 1579. So that's $170,000 or $170 more than what I'm currently doing. Highlands County is a very rural county, so the cost of living is obviously very much cheaper there. Now, when we come down to here and we look at, here's Miami-Dade, where Miami proper is, and we look at theirs is $1,791. But when we look at this one, Monroe County, one person's $2,480. Monroe County is where the Keys are. The Keys, I went down there and I spoke almost 2 years ago now. It's hard to believe it's been that long. But when I was there, they say that people can't afford to live by themselves down there. They have to have a roommate. So you can understand if this is the cost of living for one person to live, that's sometimes very hard, especially if you're earning a hospitality type salary at maybe $15 to $20 an hour in terms of living down there. And again, Orange County, Osceola County is in the Orlando, Kissimmee area near Disney. So just for comparative purposes to see how those numbers shake out. So again, using software, they help you to determine those, but you still need to know what the correct number is so that you can look at that for your particular clients. Now, what happens if they get over 5 people? Sorry, you're out of luck. It caps at 5 people. This is unlike the food, clothing, and miscellaneous, where there's an amount for, number 8, number 10, 20, however many people are living in the household, especially in the pandemic world where a lot of families are probably getting together just to save expenses. Unfortunately, it doesn't help their particular situation. Now, the Financial Analysis Handbook is an actual section in the IRM. It tells the IRS personnel how they should look at that analysis. And again, as Jason stated earlier, you should definitely look at and understand the Internal Revenue Manual. And Jason actually does a deep dive in of 6 full hours that is available in the Academy of looking at each of these different things. Now, when we look at the overview, a 433A, B, or F, that these are 3 different forms, is generally requested if the taxpayer can't full pay and they don't qualify for a guaranteed or streamlined installment agreement. On a business, they're going to ask for a profit and loss and a balance sheet. You can actually submit those instead of filling out the details of the income and expense section. This way you can just put like the total numbers to have it calculate. Partnership, single member LLC cases where the general partner member is the liable taxpayer. They're going to require a 433A and a B. The B is on the partnership. The A would be on the single member. On an S corp or on the partner or the single member. On an S corp, the wages they are going to want a 433A. And only if the S corp really has the issue will they want to have a 433B. But here the issue for both of these is that ownership in this also has a value in that particular business, and then you're going to have valuation issues there. Now, the information that goes on the 433 generally should be the prior 6 months, but in most cases, from small 941 cases and most 1040 cases, they only request the last 3 months worth of documentation and information. Now, I would, if using 6 months helps you with an averaging perspective, from the perspective, like maybe you have a client who gets overtime, bonus time, things at the holidays where they work more, and it helps you stretch it out a little bit better to make it not as big of a number because of the last 3 months and they do a lot of extra time over the holidays, and that's in your look back period, then it looks like he has a much greater ability to pay. So that's where you might want to stretch it out to say 6 months. Now, because of processing delays, because of things that just normally in the case of number of cases they're handling, number of people that are out there looking at these things, unfortunately, sometimes it can take them 6, 12 months or more to look at things, and they will want updated information. Sometimes they will allow a pen and ink change, which you just hand change some items, provide some new supporting documentation, and they will generally allow that. If something indicates the revenue officer that a major change in the finances has occurred, then a lot of times they will request a new 433. And again, for businesses, as I stated, just on the exam side, same thing happens on the business side. They will have in-person verification of the assets is required. A revenue officer will request this early on and say that they're going to need to go look at the business. They're going to need to look at and do a quick walkthrough on what they have. Now, under COVID, rules that has they have done probably more of the outside view as opposed to the inside view. I don't know if those rules have been more relaxed because of the way certain things are, but because we've had variants and other things, most people are still kind of on a semi-lockdown type of situation. As far as I know, the IRS still is as well. Now, again, please remember facts and circumstances may allow for a deviation from the allowable living expenses that we talked about earlier. We're trying to avoid the economic hardship, and please look at health and welfare of the family, production of income. Those are your two biggest arguments that you're going to make in regard to a particular situation. Now, verbal substantiation is sometimes okay, but a lot of times the revenue officer is going to, or ACS for that matter, is going to require a written documentation in certain circumstances. I've even had them like approve it, but they wanted to see the health insurance bill that we claimed because it seemed like probably a large amount. And so you're probably going to have to submit 2 or 3, say, health insurance invoices to show that that's what they're actually paying. Now let's talk about the 6-year and 1-year rules. Okay, so the 6-year rule basically says that if there may be circumstances where the taxpayer may be allowed even if they do not meet the necessary expense test. So, but if the client has the ability to pay the tax, including the accruals, tax penalties, and interest, including whatever's going to accrue, and they can pay it within 6 years, 72 months, and within the CSED period, then all expenses may be allowed if they are reasonable. Okay, so this is basically if they're going to full pay, then it really doesn't matter. Okay, as long as they can afford to pay if the math works out, it's $1,200 a month is the payment, and they can do that, then it doesn't matter what the expenses are. Now, if the taxpayer cannot do that within the 6 years, it may be appropriate to ask for the taxpayer 1 year or up to 1 year in order to modify or eliminate one or more expenses. So here's the situation. This is what it's called the lifestyle adjustment period, and here's the IRM site and where that comes from. And so here's the situation. I said earlier, you got the guy who's got an $800 Mercedes lease payment. He's still got another, say, 6 months to a year on his lease payment, and so you have that conversation with your client. You convince him to get to at least to a point where it's under the threshold, in this case, the $533 a month. So you can go get another car, but make sure it's under that threshold so that it's within that tolerance. And what that should hopefully do is give him that almost $300 difference back in cash. Same thing can apply in terms of a house. You got a taxpayer who doesn't have the ability to pay, but somehow they're making this $3,000 a month mortgage payment. And I showed you some of those numbers in terms of the housing. $3,000 was not even close to some of the numbers, even if you were living down in the Keys. So there may end up having to sell that house, get out from that debt to get to something smaller that puts them again in a better cash flow position so that it more aligns with what the 433 is actually calculating. Now, when it comes to SALT, state and local tax, what that stands for. So when you have somebody who also, typically if they're going to owe federal taxes, if they're in your state and your state has an income tax, Cruella, you said, living in Arkansas, you have an income tax. I don't know, again, where some of the rest of you are in terms of your states are, but if you have an income tax, if you happen to be in Ohio, you've got the county and city taxes as well. that typically where it's kind of where there's smoke, there's fire. So if they owe on the federal, they're going to owe on the state. They're going to owe on a lot of other things as well. So this is where we tell people deal with the lower level, work your way up, get them set up in payments. The IRS is more likely to allow it. Although please keep in mind the lien rules are going to come into play with some of the stuff that Jason mentioned earlier. And look at CTR 301 to discuss a more detailed analysis on the financial analysis handbook. But the IRS doesn't automatically allow it because of delinquent states, but they're more likely to, especially if it's something reasonable. I had one guy where he had an amount that he'd already agreed to with the state of Wisconsin. The IRS allowed that. It wasn't anything that was questioned. I think it was like $90 a month. Okay. Now, when it comes to verifying the financial information, please note that the IRS has many, many resources at their disposal. They can actually summons records from banks and other financial institutions. They can contact employers, customers, and vendors. Now, obviously, there's within reason, there's certain rules that they have to abide by in order to do that, but they can do some of that. They can request info from other federal agencies, state and local governments. I always say that, hey, they have the key to the so they can find out certain things in terms of firearms. What is that? The ATF. And they can go and have the key to the State Department to know where you've been in terms of things to determine whether or not the statute of limitations, the CSET has any tolling periods. So they have a lot of those types of resources. They ask for substantiation of expenses in the local standards category. And they can check commercial databases. So they have spots to know what house is worth. They know what kind of real estate you own. That's public record. Again, revenue officers are trained out how to sniff some of this stuff out. And you should be doing your due diligence to find certain things out in that regard. A lot of this stuff is public records. And a lot of that we have access to. Sometimes it might cost a little money, but it's certain things that you need to go out and do. Now, the Form 433F, this is what we refer to as the little sibling of the Form 433A. It's a much shorter form. It's much more abbreviated. ACS personnel are trained on the F, not the A. So don't fill out the A and expect to give it to an ACS person and them know it and like it. They don't understand all the forms. They know what they know. In the CTR 111, 112, we focus just on the A and B. We don't talk about the F. It's basically the same info as a short form. This is what the F and the A looks like. And I forget, I think the Form 433A is like 12 pages, and the Form 433F is, I don't know, like 4 or 8 pages. Give me 1 second and just double check. I keep forgetting because it's not something I normally look at a lot. The F is 4 pages and the A is 6 pages. But you're going to have probably a lot more supplemental information in terms of the A, but this is what the first page of each of the respective forms looks like. So this, you can see the F kind of gets to the point where the A allows for a little more detail. And you can always attach supplemental schedules if necessary, if there's too much information to put in the fields here. Now, here are some useful links when it comes to preparing these. What I definitely say is have these links available for the collection financial standards, as I showed you before. Verify the numbers, especially if you're using a software like the, I only use Canopy. I've never used anything else other than Canopy. So, it allows for the ability for a client survey. So the client gets a link, they start inputting their information. And so that allows them to be able to put in their information, how much they're paying for rent or their mortgage, how much they're paying for food, clothing, and miscellaneous, and their mortgage payment, their car payment, the value of their car, those types of things. And so you need to know that the program is calculating the right number, whether it's whether you're allowed to take an excess or not. Certain things, like for example, the IRS does not allow voluntary retirement contributions. So so that's a 401k, IRA contributions, those types of things aren't going to be allowed. That's a conversation that you need to have with your client. Unfortunately, I tell people there's a lot of some difficult discussions you're going to have when you're dealing with your client from the collections perspective. When having that conversation, you need to get rid of that car, you need to sell that house and go to something smaller or something more affordable is not an easy thing. I literally had an 83-year-old woman cry in my office because of that's what I was suggesting, that she could sell the house, go to something smaller, and she could pay off her liability and be done, and then fix everything on a go forward basis. But we ended up finding an alternative way to get that resolved for her. So here's the links for the A, the F, and the H. The H is basically a cross between the F and the D. The form 430D3D is the form that they use for direct debit drafting of their bank for the payment. So the H has both of those things on there. And of course, then there's a form 433A OIC. And like I said, we're looking at this more from an individual perspective, but there's a form 433B OIC, the form 433B for the business side of things. And then for further information in the Financial Analysis Handbook, here's the IRM site in regard to that. Now, I would highly recommend that you look at this particular section of the IRM. There's a lot of good information. There's a lot of good examples that they give in terms of stuff. And sometimes it hits perfectly on a particular situation you're dealing with a particular client. And then some where, it's like any other type of research where it's close, but it's not exact. Yours is a little, you got a little twist on a type of situation, but it might be something that it might help. At least you can make an argument for a particular situation. So I would definitely recommend that you try to get through that particular section in the Internal Revenue Manual. And obviously to go further, even from the perspective that, again, every case is going to be different, and you need to do your due diligence in terms of the financials. You have to dig deep and understand people and what they are dealing with. Unfortunately, you're going to have some other awkward situations because you're going to have to get bank statements and other information from people. And as Jason likes to say, there's certain things that, one man shouldn't know about another man, if you get my drift, that you'll see in bank statements. You'll see what they're spending their money on. It's one thing when it's coming from Amazon, and then when it's coming from something that you just, wish you didn't see, so you're going to have some awkward and difficult situations when you're dealing with people in terms of the financial standards. Now, Carl says, I tell our clients that OICs are very invasive and there is no privacy. Yeah, I mean, when it comes to an offer and compromise, current not collectible, partial pay, where you're actually having to submit a lot of that information, or when the dollar amounts are over what is the what we call the slam dunk, or anything above a large non-streamlined installment agreement where you have to provide financials, you're going to have to provide a lot of information. Not only that, but they're going to look for a lot of information. They're going to look and see, are they any legal cases, were they out of the country, and they're going to look at things that sometimes you're just surprised on how much stuff is out there. Not that they're going to look on the dark web for things, but you probably could find things out there too. So that's a good point. Thanks, Carell. Okay, so with that, again, as we sign off here at this section, to let you know that these are the additional things that we talk about, because I talk about the exam side. We're talking about a lot of alternating different things here. We don't get into talking about levy releases, penalty abatements. collections appeals, details, collection due process appeals. Each one of these is really a class in and of itself. Account monitoring is something else more on a marketing aspect of things, plus all of these additional services that you can provide. And again, whether you're new or you've been doing this a while, I'm sure there is things that we all can learn. I mean, I go to many continuing education classes where, like the IRS tax form, I go every year. And do I get a ton of information out of it? No. But do I get a few good little nuggets that might help me in a particular case or in just in my practice in general? Yes, I do. So again, come out and use these resources. Again, if you're interested and you want to jump right in, feel free to come in at the champions or titans level. The titans are people who really want to grow their practice with more marketing and practice management information. And Jason just actually did a workshop yesterday, a couple of days ago, in terms of some marketing that we've gotten a lot of good comments from people that they want to do some new marketing things. Now is the time to start doing marketing for tax prep, for collections cases, and so if you want to step up, feel free to do that. Again, this is the list of the classes that we have that are available in the foundations level. This is the 50 hours of CPE, and there will be some more classes, and we're going to be redoing some of these here with some updated information here shortly over the next few months. And again, these are some of the resources available, both from a marketing practice management perspective. Jason's got a sales class that he does. He does a class on quoting fees. And I talk about that from a general perspective as well. Again, we got the tax resolution office hour calls once a week, generally once a week. I miss a few a year because of varying different things, and Jason will sometimes step in. But we talk about a lot of different issues over the course of time in terms of the office hours calls, and they're very helpful. Again, we list everything that we do in terms of webinars, any live training webinars you get as part of your membership. So if you're a member, you can come to this class that I'm doing actually next week to update the third-party authorizations class, and coming to the office hours to get some further information. Plus, you get to input. This is just like if you were posting in a Facebook group. The only difference is you don't have all the distractions, the advertising or anything else that you can get sucked in with Facebook. When you're here on our platform, you are here on our platform. And the only thing that you can suck in is something that should be beneficial. You're going to learn more about marketing, about sales, about some other detailed technical class. So again, if you haven't already, here's the link to go through and good morning, everyone. This is Dan Hens, CPA, coming to you from Rockledge, Florida, where you are here for the IRS exam representation sweeping overview. This is designed to give you a base understanding of exam representation and kind of why you should be having this and adding this as a part of your practice. So without further ado, let's go ahead and get started with, we have some administrative slides. This information is copyright protected. This information is as up to date as we know it. Okay, so let's set some expectations here. This is a class that's called a sweeping overview, and it's done so for a reason. It's a broad swath of topics. We don't go into grave detail into a particular area. And so, what I'm hoping here is that, once we're done with the class, that you'll be able to familiarize yourself with the IRS audit landscape. And again, exam and audit are words that are done synonymously. The technical term is exam. The IRS, the rest of the world knows it as an audit. But we also know in our world that there's a financial statement audit. So audit has a different connotation in our world. So that's why it's called exam. But the rest of the clients that we deal with will know it as audit. Hopefully, you'll expand your horizons in regards to the IRS exam representation and gain a better understanding of how the IRS looks at a taxpayer's books and records. And will hopefully recognize that appeals can be an important part of your tactics. Okay. So, so hopefully you'll be able to get through all of that and help you to better understand it. Now, to hopefully get you a better lay of the land, I inserted this, and I know it's very hard to read, but this is the taxpayer roadmap, and the latest version of this is from 2019. This was put out by the Taxpayer Advocate's Office, and it's designed. I actually have a paper copy of this that I had mailed to me from the, I forget, there's a unit where you can go and get publications mailed to you. I actually finally just framed that and have it hanging in my office. And I think this, most of what we deal with in representation is the collection side and the exam side up here in the upper right. So, and then appeals, and if you're tax court certified, you get into the litigation side. If you're in the tax prep, you're over here. And as you can see, it goes around and around and follow the bouncing ball all around. And I love this just because this shows the craziness that we have to deal as tax professionals. And it shows, and it provides value to us. It shows the extra hoops and everything that we have to deal with as professionals and know to represent uh, clients, taxpayers in front of the IRS. And then obviously for those of you in various states, then you just have this times two or three, especially if you're closer to other state jurisdictions, or if you're so fortunate in a state like Ohio where you have city and county taxes that you have to deal with as well. But I wanted to put this in here so that you guys can see from the complexity, and this is actually internally driven from the IRS. Like I said, it's a taxpayer advocate who created this and put this together. Now, take it a step further. There is the Taxpayer Bill of Rights, and these are like the normal Bill of Rights, the 10 Commandments. There's 10 of them, and it's important that you know this, especially being a representative. There's 5 that are very important from a representation standpoint, and the other ones are really good to know. Now, uh, the right to be informed, so obviously to let them know what's going on and telling them the process, the right to quality service, which is a big point of the Taxpayer First Act that was created in 2019. So there were some improvements that have taken place in the IRS internally for that to improve their customer service. The third one here, the right to pay no more than the correct amount of tax. That's one of the important ones that we need to be recognize as a representative for a taxpayer. The right to challenge the IRS's position and be heard, which then brings you to the next step that there's it's the start of, hey, we have opportunities to challenge what they're saying and obviously fight and support that. And then secondly, that will then take us up to the top right here, the right to an appeal an IRS decision in an independent forum. So the right to challenge can be taking it up to a manager. The right to appeals is a whole separate thing, and sometimes you have to have that ticket to go to appeals, depending on whether you're dealing with exam or collections. But typically, that's a situation. Obviously, they have the right to representation, which is the lower left. So these 3 are important here. The right to appeal is the other one, a fourth one. The right to finality. So hopefully we can put this to an end. Unfortunately, sometimes that in many cases you've ever read in tax court, there are some that are literally out there for 5, 10 years, especially when they start going through past tax court and such to deal with it. But eventually you'll get to some finality. There's the right to privacy. There were some new things put in there also from the Taxpayer First Act. The right to confidentiality, And then the fifth item that I say that is important from a representation standpoint is this final one on the lower right, the right to a fair and just tax system. So there are things that we need to see in regards to that that hopefully will um, help you in representing your clients. Now, first, what I thought was is a good view to look at what the IRS operating divisions are. When there, these are the main areas. There's a head of every department there. A few years ago, I went to an AICPA tax conference where they had the IRS commissioner and they had all the heads of these divisions that were there. And actually, the one that I haven't listed on here is the criminal investigations division. In fact, they had a change there recently. Um, but wage and investment is one area that's basically individuals. Tax exempt governmental entities, which is obviously anything that's a non for profit government entities that have to deal with taxation issues. There's the small business self employed area. So, those of you that deal with business returns, that deal with self employed people who file Schedule Cs, that you're dealing with that area. And then lastly, there's the large business and international division, and those are dealing with the bigger cases, the bigger conglomerates, international companies that are doing business here in the U.S. as well. Now, other areas of the IRS that you also need to be aware of, appeals is actually a whole separate, the head of appeals goes directly to the IRS commissioner. There's nobody else within the IRS that appeals is supposed to respond or report to. Then there's the chief counsel. Many times chief counsel is always behind the scenes of things that we're dealing with. So like to get to appeals, a lot of times cases have to be conferred with somebody in the chief counsel's office. If you don't get a resolution, or as we found through the pandemic, that dealing with the National Taxpayer Advocate is an important area as well that you may need to deal with. Then we have the Office of Professional Responsibility, which is really governs Circular 230 as well as the EAs and their licensure. There's the Criminal Investigation Division. There is the Whistleblower Office, and then finally the Treasury Inspector General for Tax Administration, or TIGTA. They are kind of the internal audit arm for the IRS. They actually look at various things to see if they're following the rules that they're supposed to do. Which, if you've ever read a TIGTA report, it's actually very interesting and good reading. And I suggest that if you can, to do so, just so that you can get a better understanding, because it talks. There's one that was done in 2013 about appeals and how cases went through and got to appeals, and they've done all different areas and aspects of it. And it's interesting, even the replies that the IRS has. Just it's no different than an audit report, from financial statement management report, and their responses. And so the IRS says, "Hey, we agree or change these, and we're not dealing with any of these." In their findings. So it's quite interesting. Now, that takes us further into, let's talk about some statistics. Now, over the last 3 fiscal years, this is what the IRS has done. And I thought it was interesting to put this in here for a few different reasons. One, I've put in all of the number of returns that have been examined. So as you've seen over the last few years, the numbers have dwindled. Uh, that is partly due to financial reasons, meaning that the IRS has lost their budget numbers over the last few years. And secondly, they have also losing a lot of bodies. The IRS is, over the last number of years, have had a lot of people retiring. They've had a lot of the 30 and 40-year people, and I've met a few of those over the last few years that have left and now have gone into our field, preparing returns, representing clients. And so when you look at how many cases are being done in the field versus correspondence, And then I actually did a percentage wise here on how looking at the number of individual returns. So I look at the number of individual returns examined in total versus the total, and you can see it's almost it's a little over 88%, 90%, 88% of those returns that are examined of all returns are individual returns. And then I did a percentage here showing individual returns that are examined in the field percentage wise, and then correspondence. So most of the correspondence returns are done on the individual side, which you can understand it's not as easy to do it on the business side of things. So that makes total sense from that perspective. Now, more field audits are obviously done on the corporate side, and so that's where I would say why there's a big discrepancy in these numbers. But they're very relatively close in terms of the numbers. But the numbers are going down, which from a tax prep perspective, that's great, but from an exam perspective, that's not so good because there's not as many challenges. Now, having said that, I personally feel like that is beginning to change. I think I've seen an uptick in the number of notices, and I say that just because of the number of phone calls that have come into my office dealing with the CP 2000 notices, the primarily those types of situations where they need to provide further information. Now, if we take it a step further, what I did here was added the additional tax dollars collected from all of that. And so when you look at the total, so I went back and did the last 6 years here. This is the total revenue that was collected. And so this fiscal year 2019 was really kind of interesting to see. You can see that the numbers are almost kind of dwindling down uh, for those years. And then when you look at the total, it's probably about the 40% is, or just under 40% is actually collected from individual cases. So, uh, so anyway, it ultimately it boils down to the fact that you need to be aware of these numbers just because you need to help defend people and clients. So why should you care? There are not as many tax professionals that get into exam representation. There are a lot of people that they go into representation. They work on the collection side of the house. I also handle cases on the collection side of the house, and that's something you can do too. But the exam side is not, because I get questions from practitioners all the time on how to handle this and how to handle that, and you'd be surprised on the way to handle a situation. Seems logical in one case, but it'll totally hose up and gum up the system if you don't do it right. And this work can command $300 an hour plus. That typically is where I sit is at $300 an hour, and many people uh, are not even doing anywhere near that for tax prep. So if you could go from $50, $100, even $150 an hour to $300 an hour type work, then you're just having to work that much less to meet the same amount of income. Okay. And at the end of the day, I like to say when it comes to a notice, most taxpayers know they should seek professional help. Unfortunately, they don't figure that out the first time when they prepare their returns that they should seek professional help, because I've gotten a few of those people who have come in and said, "Hey, I think I screwed up my return." And so usually the answer is then I don't proceed to file that return or my next return or something of that nature. So now they're behind on a few years, which only adds insult to injury on top of that. So there are plenty of people out there to be had that have the problems with the IRS. Now, just let me just start with that the top items you need to communicate first to all clients. Um, the IRS, letting them know that for audits, collections, that the IRS makes communication via mail first. They generally don't just show up. However, revenue officers, revenue agents do show up at the doorstep. They leave a card. There's ways you can go and verify that they are who they say they are. But typically, they will not do it via phone. They will do it through the mail. Let your clients know that whether they hire you for representation, tax prep, anything of that nature, let them know that to not talk to the IRS and say, here's my professional, or I'm going to hire a professional, whatever the situation is. Let them know. And if that's the case, then they don't need to say a word. Just like, you get arrested for a criminal issue, they read your Miranda rights, and they tell you anything that you say can and will be used against you in a court of law. So it's kind of the same principle. And I just tell people, don't say anything, and let me handle it. Uh, Another principle here is get the documentation, have the client get them all documentation to you ASAP, and request duplicates. And if necessary, postpone the audit if you or the taxpayer aren't prepared for it. You can ask for a delay on that, although we'll talk a little bit here in a few minutes what that does on the other end. Now, the basic timeline for the exam process is this. The IRS selects the taxpayer. They send a letter of audit normally to the taxpayer. Again, that can be in the form of a correspondence audit. So it does not have to be something where you actually are physically dealing with an IRS revenue agent or a tax compliance officer. The taxpayer or the representative with the power of attorney responds. The audit commences, audit concludes, you go through the process, and you either agree or disagree. And if you disagree in whole or in part, then sometimes you'll need to go to appeals. So we'll be talking about a few different aspects of this here. Now, first, what kind of starts this whole process is the creating of the assessment statute expiration date, also known as the ASED period. Under Code Section 6501, it's a 3-year period after the return was filed, whether or not such return was filed on or after the date prescribed. So if they bring it to you 10 years later and you're now filing, the return from 10 years ago, the statute of limitations never ran. You file a return, now the 3-year clock starts. Okay, and that's the 3-year window that the IRS has to make any changes to what was filed. Now, if a return was never filed, technically they can audit that into perpetuity, but typically that's not what happens. Usually that's where they generate the substitute for a return, and they do that only for assessment purposes. And that's only done for collection purposes. It has absolutely nothing to do with the ASED period. So if they file a substitute for a return, that is not a return that starts this clock. So I want to make that perfectly clear. It's an actual return that's actually being filed. Okay, so that starts this 3-year statute of limitations. And as a side note, since I'm really focusing more on the individual side, if you were dealing with on a payroll side, the statute of limitations starts on April 15th of the year following the calendar year in which you did payroll. So, for example, if you were dealing with a 2015 return, a 2022 return of payroll returns, you're the 4 quarters that clock starts on April 15th of the year following. So if I said 2013, then it starts April 15th of 2014. That's when the 3-year clock starts for all 4 quarters. Now, how does the IRS pick returns for exam? As you can see, there's many bullet points. I think there's about 13 different items on here in ways that the IRS finds how they, when somebody hasn't done something correct. Now, the most common one is the automated underreporter. That's the document matching the CP 2000 notices that your clients get. That's why it's always nice to, unfortunately, at this point, the IRS's system in terms of wage and income transcripts don't post until like May typically. So most returns are done before those even post to know, but it is good to if you get power of attorney or even an 8821 on your clients, that you can go back and review that to make sure that that's not happening. The biggest reason to do that it would be worth it is to save the 20% a substantial understatement penalty. Probably the next most common one is high income earners. They're going after the return is done being scored. And then, of course, there's other ways here that are a lot less common in terms of that. But just to let you know that there are multiple ways for the IRS to find out ways and look at a taxpayer's information more in depth. Now, employees that you deal with on the exam side of the house. You have a tax examiner who deal typically with the correspondent exams. You have a tax compliance officer who are basically inside people. They deal with the office exams. They don't actually go out in the field. And then you have a revenue agent who is works inside and outside. They typically will do the field exams where they show up, preferably at your office, to gather the information. And then, of course, appeals officers, and they are now all called appeals officers. On the collection side, they were typically called settlement officers, but again, after the Taxpayers First Act, that everybody is now called an appeals officer. But if you go under the old nomenclature, appeals was typically the exam side of the house, and settlement officers were appeals people on the collections side. Now, what's the difference between a tax compliance officer and a revenue agent? This was told to me by a tax compliance officer. They do twice the work for half the pay, is what she told me. So basically, they do the same thing. I don't know if I think there might be an education requirement that's actually different between the two, but that's what how she put it to me. Now, how do you represent a taxpayer in front of the exam? First, you have to have a power of attorney. We have a class that I have taught here for third-party authorizations. Actually, there's two different classes. I go into depth talking about the power of attorney, one comparing and contrasting the 2848 versus the 8821. Why would you use one versus the other? And then I go in an in-depth 2848, how to properly prepare and fill out the form 2848 so that you don't get it kicked back by the IRS, because when they're kicked back, they go back to the taxpayer. They don't come to you. And it just makes you look silly when that happens, especially when it is sometimes for just a silly little thing. But that must be completed. And if you have a client who is deceased, power of attorney stops when they die, and you need to know the proper process and procedure in order to get that accepted. Now, who can represent taxpayers in matters with the IRS on the exam side? Now, on the collection side, it's only attorneys, CPAs, and EAs. That's it, period, end of story. The top three on this list, that's who can deal with on the exam or on the collection side. On the exam side, there's obviously more people who can represent in regards to an exam matter, but they're more specific. Obviously, attorneys, CPAs, EAs have more a broad, since they are licensed to do it all. It's easy for us to be able to represent when it becomes a family member or a partner in a partnership, somebody who's in the AFSP program or an unenrolled tax preparer. It's very limited in what they can do in terms of representation. Now, some pre-audit considerations. Review returns of all related entities and taxpayers. Okay, so these are things that, hey, you've gotten the letter, you're about to be audited. It's usually 60 days before the audit commences. Start reviewing returns for related entities and taxpayers. So, family members that might, especially if they're involved in related entities, partners who are involved even though they might not be family. So look at that. Review returns of other tax years. So are there a pattern of errors? Because if you see that, then please, let your client know that it's going to be easy to see that it could get expanded to multiple years. Which, having said that, as a side note, if your client gets audited, like let's say they get selected today and they get audited for a prior year return, that wait to file the current year return. Extend it if you have to. Wait till the last minute if you can, because if the return is not filed, then they can't audit it. They can't include it in the audit thing and try to get it all resolved before that point in time comes. I've done that many times, and there's nothing they can do about it. Okay, as long as even if you filed it late, which I don't recommend, But as long as they don't owe, they're not saying that they owe anything, then it's easier to get that through. Review state and local returns, just because do the numbers match? Are the information that's reported on the state side reported on the federal side, and vice versa? This is where you look at sales tax returns on the business side. Look at the state, the city county stuff. Does all of the income match across these returns? Because those are things that they're going to ask for. Review prior examination reports, if any. Sometimes that does happen, not very common, but you want to know those types of things. Uh, Review internal controls. If the client has very poor internal controls, that's going to be a big negative against them if the IRS sees that. Not that they're doing an internal control audit, but they will ask certain questions. Who handles the reconciling of the bank accounts? Who does the depositing of going to the bank to make the deposits? Who fills out deposit slips? Who does the payroll? If those are all the same person, then that is very poor internal controls. Now, there's not much you can do about that in regard to a small business, but if they can at least have some internal controls, that'll help them. Are you dealing with sensitive issues such as Schedule C taxpayer, cash intensive businesses? Especially if you're dealing with somebody like cannabis in the cannabis area. So you should know and understand these issues, and then meet and discuss your review with your client before the audit begins. Know where the skeletons lie, if any exist in a return. Now, how can you gather this information that you need to assist your clients? Well, obviously, you can get it from your clients. You all should have an e-services account, and if you haven't, please do so and get that set up. You can pull account transcripts, wage and income transcripts, tax return transcripts. Account transcripts go back to 98. Wage and income are for the last 10 years, and tax return transcripts are only good for the last 3. You could also do a Freedom of Information Act request. You can do it in writing or do it electronically now. This will help you get work papers or documents that the IRS has on the taxpayer, and you can deal. That's best to deal with closed cases that you might want to reopen later, which I'll talk about a little bit. You can actually do a Form 4506 request. The taxpayers can go to the Get Transcripts and get it themselves, or even prior tax preparers. Now, the audit, you want to humanize the process. The goal is to get it done, get it as quickly completed as soon as possible. Cooperate with the examiner in a timely manner, whether they're being a jerk or not. Okay, just do the best you can to be professional. It's not intended to be an adversarial process. Some people are horrible at it from the IRS's perspective, but from the perspective of the IRS, they have some really good people. Some people that are going to be really nice and friendly to get you talking. So some people are really good at their job. Avoid any misleading information of any kind. Please know that it is a crime to lie to a federal employee. So please do not do that. And then document control. Make duplicate copies of documents provided. Know what you gave them. Please keep copies. Whether you copy it or scan it is perfectly fine. Now, taxpayer prepare written questions in advance. Try and get that. The timing, when things need to be done. And this is, if we're talking about an interview of the client, I don't recommend that you do that. Don't ever have the client anywhere near when the IRS representative is on the phone in your office. You're going to their office, wherever you're meeting. The only time, and even then, they shouldn't even be there if they ever have to come and do a tour. So here at the bottom, I talk about here, anticipate tours of a business site. Have somebody knowledgeable there to help them go through the tour. Make sure you do a walkthrough if you can of what's out and what's not out. Things that if there's a sign on a box that says shred if IRS shows up, then that shouldn't be visible for an IRS employee to come by. Explain their business practices, and it should also not disrupt the business operations. Now, in if you're getting an interview, be comfortable and personal. Ask for clarity if you don't understand questions. Maintain appearance of cooperation, whether you're cooperating or not. And then again, this is where I just say just don't allow them in the room. So this is more for your purposes, to just try and make sure that you're doing the best you can. Now, you can ask to have the an interview recorded. It must be requested in writing 10 days in advance, and be sure you bring some recording devices. With smartphones nowadays, you can answer or have an app on there that will record. Just know that if you forget, please try to do something, because the IRS will have the recording equipment there. The exam process, again, the IRS will issue what we formally call an IDR, information document request. Look at the items that are being requested, provide timely narrative responses. If the representative needs to go anywhere, have them come to your office, not to the client's home or their office if you can. Do not have them work there if at all possible. However, on large corporations, typically they have an actual office for them because they typically live there. Provide as much documentation where possible. Use the Cohan rule if necessary. Pay attention to the due date of requested information. Try to do your best to meet the deadlines, or if you can't, communicate that to the IRS representative. Hey, I need a few more days. I need another week. And just as long as you communicate with them, they're usually pretty amenable to allowing you to have more time. Now, it can become a point where the IRS can request to extend the period. They need more time. How much time is reasonable? You need, typically they'll go 12 to 18 months, depending on how much is already left on it. And you can request a restricted extension, if applicable on specific tax issues. There's a whole Internal Revenue Manual section just specifically on that particular issue, what the requirements are, and how you can go and get that. Now, a couple of things just to be aware of. In the exam process, the IRS does use indirect methods of determining income. They use unexplained bank deposits. Expenditures can exceed financial resources. Are they hoarding cash somewhere? Cans in the back of the backyard. Unexplained increases in net worth, and the markup analysis. So these are ways that you should be looking at more in depth on how to deal with the exam process. Okay, which then you should also look to the audit technique guides. Now, once the exam is done, within a few weeks of your closing conference, you get the examiner or supervisor will send a package with a letter known as the 30-day letter, knowing the right to appeal. And then if you're going to do it, you need to do it in writing, and it needs to include these 5 items, or these top 4 items. They include a copy of publication 5. You have 30 days from the date of the 30-day letter to tell them that you're going to appeal. Now, if you don't deal with that, then you get the 90-day letter. If you don't respond, you you get to request an appeals officer, and this usually comes from the notice, or starts the notice of deficiency. But also know that this is also your ticket to go directly to tax court. I generally don't recommend going straight to tax court. Go to appeals first, because if you don't meet your what you're really looking for, then tax court is still an option, as long as you haven't signed the exam report agreeing to everything. You can typically go to appeals or go to tax court, which typically gets you another. Moving on. Now, again, you've submitted your formal protest, you go to appeals. Once you go to appeals, you sit there. They're typically an informal process. You're dealing with an appeals officer who hears about your situation, and you're typically dealing with the case as it is. Okay, if there's typically new information that's provided, this is whether it's on exam or collection side, it's typically got to go back to the exam side in this case, to have them look at that information to see if there's any changes, before the appeals officer can basically help make a determination or come to an agreement. But typically in appeals, you can submit the information, tell them, here's what my situation is, here's what the facts and circumstances are, here's what the case law says, tax court, whatever the situation, and you present that to them, and then they agree or disagree. And this is where you can then also ask for reduction in any penalties, which includes the substantial underpayment penalty. Typically, as long as there's not a willful disregard or negligence involved, they typically will reduce it, maybe not necessarily eliminate it. So instead of a 20% penalty, if you can get down to 5%, that's a win. And then if, again, like I said, if you don't get the result you're looking for, you can still go to tax court. Now, at the end of the day, the appeals result is just going to be no different than the actual exam result. You can get a no change audit, reduce the tax liability, or there's actually no change in the tax liability, and then that's when you have to then deal with it further. Now, if you end up getting to a result in appeals that you can agree with and everybody's happy and sign off on it, you can then also, if your client cannot full pay that liability, you can then also submit a 433A or F, along with any supporting documentation, offering compromise, whatever, installment agreements, currently non-collectible. You can submit that to the appeals, and they will send that to the collection side of the house and get that case resolved there. Now, what happens if a taxpayer doesn't respond? That happens all the time. They move, they never got the letter. IRS still goes through and does their process, and they will make an assessment. Please note that there is audit reconsideration and there is an offer in compromise, doubt as to liability. Now, audit reconsideration is just the process that the IRS uses to reevaluate the results of a prior audit. Okay. There are a few facts and circumstances that it's very limited to, in which the you can submit for audit reconsideration. So if they, like, for example, if they've signed the exam report, then audit reconsideration is off the table. Now, alternatively, you can go to the doubt as to liability. Now, doubt as to liability, offer and compromise is an offer and compromise. You still need to make an offer on an amount, but it's done on Form 656L. Form 656L is processed by the exam side of the house. It is not, and then collections has opinions on it, but it's exam who processes these in the Brookhaven campus. And I personally actually went through this particular aspect on my own. I had received a correspondence audit that was challenging my daughter's education credits, and went back and forth with documentation. Finally, the third reply came back from the IRS, and it was in the middle of tax season. I missed my deadline to resubmit. So I did the offer and compromised out as to liability, submitted all the documentation. It was actually sent to an exam person in the local office who was a tax compliance officer that I had dealt with before. And she told me, hey, I agree with everything. Everything is good. So so it is a process. And again, as we sign off here at this section, to let you know that these are the additional things that we talk about, because I talk about the exam side. We're talking about a lot of alternating different things here. We don't get into talking about levy releases, penalty abatements, collections appeals, details, collection due process appeals. Each one of these is really a class in and of itself. Account monitoring is something else, more on a marketing aspect of things, plus all of these additional services that you can provide. And again, whether you're new or you've been doing this a while, I'm sure there is things that we all can learn. I mean, I go to many continuing education classes where, like the IRS tax form, I go every year. And do I get a ton of information out of it? No. But do I get a few good little nuggets that might help me in a particular case or in just in my practice in general? Yes, I do. So again, come out and use these resources. Again, if you're interested and you want to jump right in, feel free to come in at the champions or titans level. The titans are people who really want to grow their practice with more marketing and practice management information. And Jason just actually did a workshop yesterday, a couple of days ago, in terms of some marketing that we've gotten a lot of good comments from people that they want to do some new marketing things. Now is the time to start doing marketing for tax prep, for collections cases. So if you want to step up, feel free to do that. Again, this is the list of the classes that we have that are available in the foundations level. This is the 50 hours of CPE, and there will be some more classes, and we're going to be redoing some of these here with some updated information here shortly over the next few months. And again, these are some of the resources available, both from a marketing practice management perspective. Jason's got a sales class that he does. He does a class on quoting fees, and I talk about that from a general perspective as well. Again, we got the tax resolution office hour calls once a week, generally once a week. I miss a few a year because of varying different things, and Jason will sometimes step in. But we talk about a lot of different issues over the course of time in terms of the office hours calls, and they're very helpful. Again, we list everything that we do in terms of webinars, any live training webinars you get as part of your membership. So if you're a member, you can come to this class that I'm doing actually next week to update the third-party authorizations class, and coming to the office hours to get some further information. Plus, you get to input. This is just like if you were posting in a Facebook group. The only difference is you don't have all the distractions, the advertising or anything else that you can get sucked in with Facebook. When you're here on our platform, you are here on our platform. And the only thing that you can suck in is something that should be beneficial. You're going to learn more about marketing, about sales, about some other detailed technical class. So again, if you haven't already, here's the link to go through and